Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Shifa Nadira binti Rais. So today my group will be present about the Ivory Properties Group Berhad. Ivory Properties Group Berhad is a property developer that located in Penang and Northern Malaysia. It was established in 1999. This company offers various types of properties such as medium to high apartment, condominium, bungalow, retail and commercial unit. They have been received many awards such as the Age Malaysia, Star Property, Golden Bull and Asia Pacific Property. Ivory Properties was listed on Market Bursa Malaysia since 28 July 2010. Ivory Properties always strives to live true to its vision, which is building a better world for our future generation. So move on to the board of directors. The chairman is Dr. Asairina Chan. The group officer is Datuk Loh Eng Hock. The independent non-executive director is Loh Chetek. The non-independent non-executive director is Ui Chui Kyu. The independent non-executive director is Lim Hock Sui.
Hi, Assalamualaikum. My name is Siti Fatimah Nurjana binti Roslan, and now it's my turn to discuss about leverage ratio, which is the first one is debt ratio and the second one is debt to equity ratio. But firstly, leverage ratio is any one of several financial measurement that look at how much capital comes in a form of debt or the ability of the company to meet its financial obligation. Okay, the first one is debt ratio. Debt ratio are used to measure the percentage of total assets provided by the creditors. The formula of debt ratio is total debt divided with total assets. For Ivory property, the total debt is amounted to RM 263,777 ringgit, and it is divided with total assets which amounted to 649,832 ringgit, and it is a total up to 0.36% of debt ratio, which means it can be considered as a good debt ratio because it is lower than 0.4%. 0.4% is a limit ratio that compare between the good and the bad debt ratio. Ivory property shows that the company has lower in borrowing money from bank or other financial institution, and it is also shows that for every RM 1 ringgit of assets, the company has 36% worth of liabilities, which is the company are able to pay back the loan. Meaning to say here, the lower the debt ratio of the company, the safer the company will be. Okay, next is debt to equity ratio. Debt to equity ratio are used to compare the company's total liabilities with its shareholders' equity. The formula of debt to equity ratio is total debt divided with total equity. For Ivory property, total debt is amounted to 236,777 ringgit, which is divided with total equity amounted to 413,055 ringgit, and it is a total up resulted to 0.57% of debt to equity ratio. As we can see, for the debt to equity ratio for Ivory properties is in a condition of norms and limit. There are less difference between debt to equity ratio for the company compared to industry average of 51.4%. It is shown that most of the Ivory properties assets are financed through debt.
Okay, Bismillahirrahmanirrahim. My name is Nur Ali Amira binti Muhammad Nizam and I am from class 5A. Okay, now it's my turn to present about Ivory properties Berhad. Okay, my part is leverage ratio. I would like to explain about the time interest earned. Okay, so what is the time interest earned? Time interest earned measures the firm's ability to meet its annual interest payment. Okay, what is the formula for this ratio? The formula is EBIT, or we know as earnings before interest and tax, and divide it with the interest expense. Okay, let's look at the calculation part for this ratio. Okay, so this is the calculation part. We get 3.4331 for the ratio and compare it with the net industrial average, which is negative 18.03. So from the table, we can see that the ratio that we get is higher than the industry average. This shows that the firm has high ability in fulfilling its interest obligations. Okay, so what is the possible cause of high leverage ratio? Okay, as for me, I think that high leverage ratio is because of the high borrowings due to the dividend policy in the company. Okay, so what are the suggestions for the improvement? Okay, firstly, we will try to review the dividend policy set up by the company. And second, the company must finance its capital investment with the retained earning in order to lower down the leverage ratio. Okay, and third one is the company must have the optimum mixture in its source of financing. Okay, let's move to the next one. Okay, next we will move on to the profitability ratio. Okay, what do we got in this ratio? Firstly, we got GPM. What is GPM? GPM is gross profit margin. Okay, how does this GPM works and what is its function to the company? Okay, GPM works as a measurement for the gross profit earned by the company for sales. Okay, what is the formula for GPM? Okay, the formula is sales that we got from the company and the amount we will less with the cost of goods sold, and then we will divide it with the sales amount again. Okay, so GPM is basically the percentage of remaining sales after deducting the cost of goods sold. Okay, so we get 35.38% for the GPM and compare it with the net industrial average, which is 24.5%. This shows the efficiency of the company in controlling its cost of goods sold and the pricing policy implemented since the amount of GPM is higher. Now, let's look at the possible causes for low GPM. Okay, what are the causes? Okay, firstly, low GPM may be because of insufficient sales volume due to high selling price or higher cost of goods sold. And then the second one is the higher cost of goods sold may be due to expensive sources in supply of goods, higher labor costs, and high production wastage. Okay, and then what are the suggestions for the improvement for the low GPM? Okay, firstly, the company must review the pricing policy and then they need to reduce cost of goods sold by changing the supplier. And also, they need to reduce the labor cost and make sure the business is running smoothly, because if the production is running smoothly, then there will be no wastage. Okay guys, now let's move to the last part. Okay, the last part is we will be discussing about the operating profit margin. What is operating profit margin, or OPM? Okay, this term is also referred to the earnings before interest and tax. It is the percentage of sales remaining after deducting all costs and expenses, excluding interest and tax from sales. And okay, so what is the formula for OPM? The formula is EBIT, which is earning before interest and tax, and then we will be dividing it with the sales. Okay, so possible causes of lower operating profit margin is firstly because of the lower gross profit margin, second because of the high operating expenses, and third is the lower selling price. Okay, so what are the suggestions for the improvement? Firstly, we need to reduce the cost of goods sold, second, reduce the operating expenses, and third, review the selling price. That's all.
Okay, as for the next slide, I will continue. My name is Nur Najwa Atirah binti Mahazam. So let's proceed with net profit margin. Net profit margin is a revenue remaining after deducting all operating expenses, interest, taxes, and preferred dividends. Net profit margin is calculated by dividing net income available to shareholders with sales. As we can see on the table, Ivory Properties has a 0.28% net profit margin, while industry average has negative 4.4%, which means Ivory Properties has a better performance on net profit margin, which indicates that this company is pricing its product correctly and exercising good cost control. Okay, so for the next slides is return on assets, or ROA. The uses of ROA is to measure the ability of the management to make profit from the investments it's set. The ROA can be calculated by dividing net income available to shareholder with total assets. By referring to the table, we can see that Ivory Properties has a really low ROA with only 0.07% compared to industry average, which has 5.4%. This indicates that Ivory Properties has a really poor efficiency in utilizing its total assets to generate profits. However, Ivory Properties can improve their return on asset by decreasing its total assets and increasing its total profits. So last slide from me is on return on equity, or ROE. The uses of ROE is to calculate profit earned by the common shareholder from their investment in the company. It is calculated by dividing net income available to common shareholders with common equity. As we can see in the table, Ivory Properties has a good return on equity with 0.10% compared to industry average, which has only 0.3%. It indicates that Ivory Properties is very efficient in generating profit, and they can provide better return for their shareholder.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Aina Nadira binti Muhammad Azman, and now it's time for me to present the Ivory Properties number head common size ratios. So first we'll proceed with the statement of financial position of 2018 and 2019. So we can move to the slide here. There is equity and liabilities that we highlighted. So next, we'll proceed with the vertical analysis of the Ivory Properties in Berhad and the statement of financial position as at 31st March for the year 2018 and 2019. Okay, vertical analysis SOFP is kind of different rather than the ordinary one SOFP because you can see there they are also provided the amount of the item and also the percentage of the item. So this will help the company to know how many percent that they have for the item. Okay, so now we proceed with the horizontal analysis of the Ivory Properties in Berhad. So in this slide, these are the statement of financial position for the Ivory Properties in Berhad on 2018 and 2019. They are a little bit different at the last part of the SOFP. We can see that there are increase and decrease amount of the item during the 2019. So you can see that differences occurred. What happened on the 2019, and we can see that at the item we can know either the company that increases in their equity and liabilities. So here is the explanation on every company's financial statement analysis based on the horizontal analysis. So what we can see here that the company's performance is having a fall off from year 2018 and to 2019 because on their total equity and liabilities, the statement states that there were amount declining amounting 62,513 million with the percentage of 8.78% after comparing for the both years 2018 and 2019. Okay, now we proceed with the item of the company. So the first one is shares capital, and the comparison is no changes because the amount from the both years are equal. And the next one is shares, and the comparison decreases. And why? Because we can see in the support there, right? They were decreasing about 15,260 million with the percentage of 7.55%. And the next one is equity attributable to the owner of the company, and also it decreases. It decreases amounting 15,260 million ringgit Malaysia with the percentage of 3.56%. Next is the liabilities. So the first one is loans and borrowings, and the comparison is decreases. We can see that the non-current liabilities are decreasing from year 2018 to year 2019 as the amount is negative, which is RM 4,393 with the percentage 9.83%. And then is the deferred tax liabilities, and it also shows decreases, and it decreasing from year 2018 to year 2019 as the amount RM 1,962 million with the percentage of 41.51%. Okay, next is the liabilities, the current liabilities. So the first item is loans and borrowings, and the comparison between both years decreases as it dropped to RM 6,172 with the percentage of 6.58%. And next is trades and payables, and it also decreased with the amount declining RM 38 1,332 with the percentage of 27.46%. Contract liabilities, it increases, and there were no amount for the year 2018, which means the company doesn't have contract liabilities on that year, so the amount is the same. And current tax liabilities is increased also. The current tax liabilities item shows the amount RM 2,352 with the percentage of 93.10%. But we can say that the company's trend showing that their performance having difficulties in handling the equity and also liabilities, and most of the items are decreasing from year 2018 to 2019. What we can do from there, the base of their SOFP, based on the common ratio and the vertical analysis and then the horizontal analysis.
For the conclusion, Ivory Properties are not doing so well in 2019 compared to 2018 for their financial status. They have suffered massive gap of the net profit, which is they can only obtain 449,000 in 2019, while in 2018, they managed to get 13,445,000. This maybe happen because of they are undergoing a transition period before reaping the fruits of its hard work again, that declared by their Chief Financial Officer.